What's up, traders? Welcome out to tonight's special webinar on Iron Condors for beginners. This is Coach Tyler Craig with TackleTrading.com. Excited to be here. I've got a sweet PowerPoint. I've got a lot of information I want to share. I've been trading Iron Condors for pretty much my entire trading career. Been about 15 years now. So this is a strategy that I use almost every month these days, and I've learned a lot about it. I know lots of tips, lots of tricks, best practices for this particular strategy. And I can teach it and make it very, very simple and easy to understand. So tonight, you're going to see all that on display. If this is your first time joining us or seeing any of our webinars, we do invite you to come and see what all the fuss is about over at TackleTrading.com. We have a world-class community of traders that are here to help you and want you to be successful. So tonight's education is kind of a taste of what we do on a daily basis over at Tackle Trading. We actually have a premium trading system on Iron Condors called the Cash Flow Condors trading system. That we do every single month with a group of traders. So you're going to see some of the best practices and rules and guidelines that I use for that system on display tonight. 3 primary objectives for tonight's discussion. What is an Iron Condor? How do you enter it? How do you put the trade on? How do you manage it once you're in? And how do you get out? And why does this strategy make money? There's lots of different strategies you can use. Tonight, we're going to make the case for the Condor. You'll either love this at the end of the webinar and want to do it in your own trading accounts, or maybe you won't want to, but you'll at least understand why and be able to make a more informed decision. Okay, my bet is you'll like this. It's a very interesting strategy, and it is popular for a reason. So I'm going to be jumping back and forth a little bit. We're going to use PowerPoint. I'm going to take some notes here on the Word doc. I'm going to jump on Thinkorswim. We're going to build a few sample trades. But hopefully by the time we're done with this hour and a half discussion, you guys will feel much more confident with the Iron Condor. And I am logged into YouTube. I am logged into YouTube here, so I will be scanning the comment section every once in a while. But quite honestly, most of this first part is going to be me just kind of focusing on teaching, okay? But we do have veterans of Team Tackle in the chat window. So if y'all want to talk amongst yourselves and maybe answer each other's questions, feel free. But I'll try to monitor that as I can. All right, so let's start with the structure of an Iron Condor. The reason why it's a more advanced strategy is because it's a combination of 2 maybe more basic strategies, okay? And so if you don't understand the basic strategies, you're not really going to understand the Condor. So we've got to start at the beginning in building our understanding of a credit spread. So let's go through a few definitions here. I'm going to use my pen. We're going to draw a little bit as we go. So first of all, what is a credit spread? And let me even take a step back further and say, what is a spread trade? So this is an options strategy. You can buy options, you can sell options. When you buy an option and then sell a different option at the same time, it's known as a spread. And some spreads, when you enter the trade, you pay to enter. It's a debit spread. In other words, the option you're buying is more expensive than the one you're selling, and so it's a net debit to you. Other times, you'll sell a more expensive option than the one you've purchased. So when you enter the trade, you get a credit. Money comes into your account, thus a credit spread. So if you look at the definition here, a credit spread refers to an option strategy where a high premium option is sold and a low premium option is bought on the same underlying security. So if we sell an Apple call option we're going to buy an Apple call option. If we sell a Google put option, we're going to buy a different Google put option to create our spread. And again, it's going to be a net credit because we're always selling a more expensive option than the one we're buying. That's the general idea. We're going to be building vertical credit spreads. And the vertical term means that you're buying and selling different strikes in the same month. So if we buy an April option, we're going to sell an April option. If we buy a May option, we're going to sell a May option. If we buy a June option, we're going to sell a June option. You're always long and short in the same month. And when you do that, by default, it's a vertical spread. When you do it with puts, it's known as a bull put spread. So let's start with the put side. Look at the name. It's interesting. We try to make this as obvious as possible. Number one, it's a spread. So you know you're buying one option while selling another. Number two, we put the name put in the spread. So we're not using call options with this strategy. We're using puts. And number three, it's a bullish trade. So however you're building this put spread, you're doing it in a way that you make money if the stock goes up. And this you could also call a bull put credit spread. We are selling, here's another tip, you're selling to enter the trade. That's what makes it a credit. Okay, you're selling the spread. So what is this idea of a bull put? Well, first of all, you're going to sell a put option. That's the first part of the trade. We're selling puts. That part of the trade essentially is a naked put. Well, what does that mean? Well, let's say a stock's $100. When you sell a put option, you are obligating yourself to buy the stock. So let's say that I sell to open a 90 put. Selling to open a 90 put. And maybe I get paid $1. Getting paid $1. Well, I'm getting paid $1 to obligate myself to buy the stock at 90. Isn't that an interesting idea? Did you know you can get paid for your willingness to buy a stock? You can get paid for your willingness to buy a stock. See, as a stock trader, this idea is completely foreign because it's like, well, I don't get paid to buy stock. I pay other people to buy stock. Well, the beautiful thing about the options market is you get paid to make promises. And in this case, you're getting paid to make a promise to buy the stock. If you just sold the 90 put, it would be considered a naked put or a short put. Because if the stock goes to zero, you're on the hook for buying it at 90. You made a promise, no takesy backsies. You have to buy the stock at 90. So there's a lot of theoretical risk when you sell a put naked. To make it a spread, remember, there's two parts, sell an option and then buy an option against it. So what we're going to do here is we're going to buy a lower strike option. Maybe I buy to open the 85 put. Now, let's think about this. First of all, it's in the same month. It's in the same month because it's a vertical spread. We're dealing with vertical spreads here, always in the same month. So let's say I'm using May options. I sold a May 90 put. I bought a May 85 put. What does the 85 put add to this position? Well, when you buy a put, it gives you the right to sell the stock. Now, let me pause for a second. This is not a super duper basic introduction to options webinar. I'm going to make some assumptions here that you understand what is a call option, what is a put option. If you don't, just try to follow along, okay? But realize I'm putting you a little bit in the deeper end for tonight, and I don't have time to explain everything. So I'm going to do a little bit of kind of retroactive, bring you up to speed. but I can't go over all the basics, right? So just take my word for it. When you buy a put, it gives you the right to sell a stock. Well, you've got the obligation to buy the stock at 90. You have the right to sell it at 85. So it doesn't matter how low the stock goes, your risk is fixed. What people like about these vertical spreads, as opposed to a naked put, is it has fixed risk. It has limited risk, and it's a lot cheaper than a naked put. And so it's as if you sold a naked put, and then at the same time, you bought a lower strike put option. That's kind of the protection. In fact, sometimes we call it a protective put. So you're selling a put, then you're buying a put, fixed risk. That put option you buy is going to cost you a little bit of money. Maybe in this case, it cost me 50 cents. Cost me 50 cents. So let's see, I brought in $1. I paid out 50 cents. I'm left with a net credit of 50 cents. That's how much I would get paid for selling this spread. What do I want to happen? Well, this is another interesting part of vertical spreads. You're selling something you hope expires worthless. This is a new concept for a lot of people. See, in the stock market, usually we're buying things we hope go up in value. Now, if you've ever shorted a stock, you actually do kind of have an idea of selling something you hope expires worthless or goes down in value. So when you think about credit spreads, they're analogous to shorting stock in the sense that we're selling something we hope expires worthless. And if it does, you get to keep what you got paid up front. So what would cause these puts to expire worthless? Well, if the stock went up, the put options would expire out of the money and they'd be worthless and you'd pocket the 50 cents. If the stock went sideways, the puts would remain out of the money, they would expire worthless, and you keep the credit. The stock could even go down, just not down more than 10 bucks. The risk is if the stock goes below 90, then you start to lose. We'll talk more about that in a moment. But conceptually, I want you to understand that a bull put spread allows you to get paid for betting the stock is not going to go down too much. Does that sound like an aggressive trade? I mean, does that sound super bullish? It's like, yeah, I'm bullish. I'm bullish enough to bet the $100 stock's not going to go below 90. I mean, that's a pretty high probability bet, right? Like, it's not like you're swinging for the fence with credit spreads. These are higher probability types of trades. Okay. So this is a bullish cash flow strategy. And that really just means that we make money as time passes. Okay, we're gaming time decay, if you're familiar with that concept. You're also bearish on implied volatility. I wouldn't worry too much about that at this point. Suffice it to say, you make money if options get cheaper. So if after I sell these puts, everybody all of a sudden doesn't want to pay as much money for options, the premiums will shrink, implied volatility goes down, and that's to your benefit, okay? In fact, if you've been paying attention to the stock market over the past 2 to 3 weeks, we have seen implied volatility drop dramatically over the last 3 weeks. 2-3 weeks ago, the market was still in the throes of a downtrend. We were on the verge of making new lows. The Russia-Ukraine situation was still really, a concern for traders. There was a lot of fear in the marketplace. People were paying a lot of money for insurance, for put options a couple of weeks ago. It's not the case anymore. We've seen a big sigh of relief for whatever reason over the last couple of weeks, and implied volatility has dropped dramatically. What you have seen play out in the stock market over the last 2 weeks has been a direct benefit to people that have bull put spreads. Okay, let's move on to the next piece. Here's the risk graph of a bull put. Here's a risk graph of the bull put. Now, could I spend an hour on risk graphs? I certainly could, but I just want to give you the gist here, okay? We've talked about risk graphs before. We have a whole segment of videos, the Jedi options segment of our videos on our playlist. A couple of those go into risk graphs, okay, if you need a primer on this. But it's a picture, a visual depiction of how this trade makes money. In the prior example, the stock was 100, okay? And we did a 90.85 bull put, okay? 90.85 bull put. Here's how it would look on the risk graph. Remember, the risk graph shows you where you want the stock to be to make money. So 90 would be right here. Oh, 100, 110, that's over here on the right. So do you see how if the stock is above 90, you make a profit? That's what you want. That's the best case scenario, is have the stock stay above 90. If the stock drops, 85 is the point at which you hit your max loss at expiration. So if the stock goes down, 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 below 85, that's where you hit your max loss, right? So down here it'd be 80, 75, etc. So you don't want the stock to go down. Your break even, let's say I got $1 credit for the trade. My break even in this case would be 89. I don't care too much if you know that, but the break even is in between the strike price that you sold and the strike price that you bought. So conceptually, the risk graph just shows you, hey, stock's above 90 at expiration, make your max profit. Stock goes below 90, start to give back some profit, goes below 89, now you're in the loss zone. Loss increases until you hit 85, then you can't lose any more at expiration. That's the way it works. Now, this is not a class on bull put spreads. This is a class on condors. But the bull put is one piece, one part, one leg of the condor. Okay, so I'm looking at the chat window. I want you guys to tell me, give me a thumbs up. Got the basic idea of a bull put? As you're telling me this, I'm going to just recap. Sell out of the money puts, buy a further out of the money put. This side of the condor, we just don't want the stock to go down too far. Okay, not a crazy bullish trade, a high probability bullish trade. Profits from time decay. Just hoping the market doesn't fall apart after we sell these. Alexander's good. James is good. Chico's good. All right. What's the other part of the condor? The other part of the condor is the bear call spread. This idea that you can sell out of the money puts as a means of betting the stock's not going to go down too much. There's a bearish parallel or counterpart to that. Just as you can bet the stock's not going to go down too much, you can also bet the stock's not going to go up too much, which essentially means you're bearish. If you don't think the market's going to go up that much, you're certainly not bullish, right? With a bear call, we're not going to sell puts, we're going to sell calls. This is just the inverse of the bull put. So think about the name for a second. First of all, this is a spread. What does that imply? Well, it implies that we're both buying and selling an option. We're using call options. So we're buying one call while selling another call, but we're doing it in a way where we're creating a bearish position, which implies we want the stock to go down. We don't want it to go up. Now, this is also a vertical spread. This is also a vertical spread, just like the bull put. What does that mean? We're buying and selling different strikes in the same month. May, June, July. If you buy a July call, you're selling a July call. If you sell a June call, you're buying a June call. Same month. It's a vertical spread. It's also a credit spread, just like the bull put. What does that mean? It means we're getting paid to enter the trade. You're selling a more expensive call. You're buying a cheaper call. So when you look at the definition here, let's go back to our $100 stock example. I got a stock at 100. I'm somewhat bearish. I don't think the stock's going to go up. And the way I'm going to take advantage of that is I'm going to sell to open a 110 call. I'm selling something I hope expires worthless. Maybe I get paid $1 for that. Well, a call option, by selling that, I'm obligating myself to sell the stock at 110. But I'm not really going to have to do that if the stock stays below 110. Okay. So this trade is effectively a bet that this call is going to expire worthless, which will happen if the stock goes sideways, down, or up less than 10 bucks. In all three of those outcomes, the call is worthless. I keep the $1. So listen, guys, if you don't think the market's going to go up, you can just sell calls all day long if you've got the trading permission for it. But the challenge is there's a lot of theoretical risk when you sell an out-of-the-money call option. Selling an out-of-the-money call option is known as a naked call. Sure, you get paid some money, but you're promising to do something. You're promising to sell the stock if it gets to that price. And if you don't own the stock, you're going to become short. Short calls, selling to open a call, turns into a short stock position at expiration, which theoretically has unlimited risk. So just as people may not feel comfortable selling naked puts because of the open-ended risk, they may also not feel that comfortable selling out of the money naked calls. So the spread is going to make this a little bit easier to swallow. You're going to buy a higher strike out of the money call. Let's buy to open at the same time, maybe a 115 call. Maybe that cost me 50 cents. That's like the protective call, just in case I'm wrong. Now, how would that protect me? Well, remember, I'm going to become short the stock at 110 at expiration if I'm wrong. And the risk with short stock is that the stock goes up to infinity, and you got to buy it at infinity and sell it at 110, and you lose the difference, which is a lot of money. So the reason that long call limits your risk is because it gives you the right to buy stock. So the stock that I've got a short at 110, I can buy back at 115, and that caps my loss to about $5. So it limits the risk. Okay, it's a not so naked call. Right, I'm covered. My risk is capped. Now, if you didn't get that on the first pass, again, don't worry about it. You just need to go back and learn the basics of calls and buying them and selling them, and what are the rights and obligations of the contract. For now, just take my word for it. When you enter a bear call, you're betting that these calls will expire worthless, which will be the case as long as the stock doesn't go up too much. That's it. It's a bear call spread. Now, look at the risk graph. It's flipped the other way. So in this instance, again, it was a $100 stock, $100 stock. I sold the 110 call. So I want the stock below 110. So that's the strike price right here, 110. So if we're below that, if we're at 100, if we're at 90, I'm making a profit. I bought the 115 call. That's this strike price. If we go above that, 120, 125, etc., I'm losing money. That's my loss zone. And in this case, if I got 50-cent credit, actually, let's say I got $1 credit just to make my math easy. My break even is going to be 111. Okay. But conceptually, I don't want to go up above 110. Okay. Okay. Now, the Iron Condor, we're ready for this. What if you did a bull put and a bear call simultaneously? What if you did a bull put and a bear call simultaneously? You would create an Iron Condor. Okay. So the Iron Condor is a limited risk, limited reward, neutral, cash flow, meaning you're making money due to time decay, option strategy. We're going to design this to have a high probability of profit. And essentially, we're betting that the stock's going to be range bound. Okay, so we're going to get paid when we enter, and it's going to benefit from time decay. That's the idea. Okay, the structure. Now the way this is phrased is it makes it sound a little complicated. You're going to buy and sell 4 different option contracts, 2 puts and 2 calls with 4 different strike prices, all with the same expiration date. Sounds like a mouthful, right? Well, all it is just combining what I have already taught you. Bull put, bear call at the same time. So look at the risk graph here. Look at the risk graph. Again, let's say I've got this $100 stock. Okay, $100 stock. What was the bull put? 90, 85, bull put, right? So I want to sell the 90, buy the 85. Those are going to be the strikes. And I want the stock to be above 90, right? You know, be it 100, something like that would be great. So that's the bull put on the lower end of the stock. And on the upper end of the stock, I'm going to do a bear call. So maybe I sell the 110, maybe I buy the 115. I've got my bear call up here. And what do I want to happen? Well, I want the stock, here's my 110 strike, here's my 115 strike. I want the stock to be below 110. Okay, like maybe 100. So I would like the stock to kind of hang out in the middle. Meanwhile, the bear call will drip in value down towards 0 because the calls are out of the money and they expire worthless. And these out of the money puts drip in value down to 0, expire out of the money. And then bada bing, bada boom. Everything expires. I keep my money. So when you take these 2 risk graphs and you push them together, it creates an iron condor. Okay, creates an iron condor. So if I've got 50 cents of credit on the bull put side, and if I got 50 cents of credit on the bear call side, then you add them together, right? And you would have gotten $1. So if you think about what's the incentive of doing a condor versus just a bull put or just a bear call, the incentive is you get paid twice. So you potentially double the credit. Okay. At the same time, you actually reduce the potential loss. Okay. So I didn't get into this, but when you do a bull put, okay, where here's your bull put risk graph. Okay, where we might have had 50 cents gain, okay, and $4.50 would be the risk. Well, if you were to add on a bear call, where independently it had 50 cents of gain and $4.50 of risk, when you smush those together, you get a risk graph. Looks kind of like this, but the reward is $1 and the risk drops to $4. So you're risking less to make more. That's the carrot. That's the incentive. With the bull put, you can make 50 cents, you're risking $4.50. With the condor, you can make $1 and you're risking $4. It almost seems too good to be true. It almost seems too good to be true because you're thinking, hey, if I can make more reward for less risk, why wouldn't I do it? Why wouldn't I want to do both sides? It's like adding the bear call to a bull put. It's almost like a free trade. I'm just getting paid and I'm not adding risk, I'm subtracting risk. The catch is the probability. Okay, the catch is the probability. See, when I just did the bull put, that 90, 85 bull put, stock could go sideways, up as far as it wants, or down just less than $10. Well, when you throw that bear call up there, you've put a lid on how high the stock can go. So you've shrunk the profit range from what it was when you just had the bull put. So the Iron Condor will have a lower probability of profit than if you just do one side. To compensate you, you get a higher potential reward. Okay. And it doesn't mean that the Iron Condor always is better. Look, in some situations when the market's really, really bullish or really, really bearish, you may not want to do a neutral trade. But if you don't have a strong directional opinion, this thing can definitely come in handy. Okay, first 30 minutes in the books, you should have a pretty good understanding now of the structure of an Iron Condor. How do you build it? What does it look like? Bull put plus bear call. Now, devil's in the details, still got a lot to work through, but do you feel like you've got the basic idea here of what we're doing? And I'll tell you, it really helps if you know how to do a bull put by itself. If you've never done a bull put before, maybe go trade a couple bull puts to understand how they work before you do an Iron Condor. And then when you come back into the Condor, it'll make more sense. If you've never done a bear call spread by itself before, maybe go trade a few of those. Get familiar with the ins and the outs, what happens when they work, what happens when they don't work. And then when you know that side individually, then you can smush them together, doing both simultaneously, and the trade will make a little bit more sense. Like there's a chronological way in which you should go about learning options and trade the verticals independent, then smush them together. The Iron Condor will make complete sense. Okay. So yeah, this is a 4-contract trade. This is a 4-contract trade. Okay. So it's a big trade, right? Like, you know, for somebody who's used to selling a naked put, they're used to paying 1 commission. You pay 4 commissions for this bad boy. And before any of you complain, okay, I don't want to hear it. We live in a golden age of commissions. So if you come back and you complain to me and you say, Tyler, I pay 65 cents a contract. Do you know what 65 cents times 4 is? It's $2.60. You're telling me I got to pay $2.60 for this whole trade, like highway robbery. To which I respond, go tell a veteran that. They'll smack you upside the head. They'll be like, listen, Sonny, I used to pay $5 a contract. This would cost $20 when I traded. Don't come at me with that 265. Get out of here. Or 260. Okay. So forget it, folks. It should be the least of your worries. But listen, to be fair, yes, it is 4 contracts for 1 Condor. Okay, enough on that. Let's get into the terms here. Let me give you some general rules, general guidelines on how people trade these in terms of time and price. What month do we use? What delta? How far out of the money do we go? Let's dig into that a little bit. You can do this on anything that has options. You can build a Condor on. So there's 2 different ways to do this. One is to say, I'm a nomad. I travel. I go hunting. I go where the caribou are and the mammoths. You know, I don't like stay in one place and build a farm. So I scour the market. I scour my watch list. I go find a stock that I think looks good for a Condor. And then I do it on that stock. Maybe it's Apple, maybe it's Amazon, maybe it's Google. I'll do it. And then the next month, I may be like, Apple doesn't look good this month. All right, let's pack up the kids. We gotta move somewhere else. All right, let me go find something else to do a Condor on. Oh, Microsoft looks good this month. Let's do a Condor on Microsoft. So maybe you roam and do different stocks each month, or you might build Condors on the same product month in and month out, more as a consistent, structural, consistent way of playing that particular instrument. And if you're going to do that, usually you'll find people that do this like I don't want to say it could be professionally, but they're not just like screwing around. They're trying to build a system with condors to where they don't have to keep finding different ticker symbols. They'll use an index or an ETF that tracks the index, like SPX, like the Russell 2000 index, like IndieX or DJX, or they'll use their corresponding ETFs like SPY for the S&P, the Diamonds, DIA for the Dow, IWM for the Russell, the Qs for the NASDAQ. And they'll do it on an index as a means of trying to cash flow an index on a consistent monthly basis. That's what I espouse. That's what I advocate. Indeed, that is what I built the Cash Flow Condors premium trading system that we offer over at Tackle Trading on. So the Russell 2000 is what I'm going to use tonight as the example. Okay. And there's all sorts of perks. You don't have to deal with earnings. There's always there's always the ability to trade it. Like you're not going to not be able to find a strike price that'll work per se. And it tends to be less crazy. There's less gaps. There's less individual news that causes this to gap up or down 10% than would say be the case with an individual stock. Okay. So Russell 2000, or if it doesn't have the right strikes, you can use its counterpart, the ETF IWM. Okay. Strategy, of course, Iron Condor. We're going to do a bull put and a bear call at the same time. Expiration date. 60 days to expiration will give you a wider range. Okay. If you want, speaking of roaming, if you want to let the price of an index roam and have a wide profit range, don't sell 1 week condors. Go out maybe 2 months, 60 days to expiration. Some people will do these maybe 1 month, 30 days to expiration. That's what DTE stands for, by the way, days to expiration. You get a narrower range. So there's not a right answer here, but when I build these using the Cash Flow Condors guidelines, I tend to go 60 days out. So I've already entered May. We've already entered our May trade about 10 days ago, in fact. Okay, the strike price. What this tells you is how far away do you go? You know, if the stock's 100, do you sell the 105 call and the 95 put and get a $10 profit range? Or do you sell the 115 calls and the 85 puts and get a 30-point profit range? Like how far away do you go? Lower deltas translate into wider ranges. So if you sell a 10 delta on each side, you're going pretty far out of the money. So let's start with that. Let's go 10 delta or less. I will tell you with the Cash Flow Condor system rules, we're usually a delta around 8. Sometimes it'll even be a delta around 7. Okay. And that gets you a nice high probability of profit. Okay. Them's the terms. So here's IWM at 200 bucks. If I did a bull put, I might sell the 160 strike down here. And if I sell the 160 strike, I'm probably buying the 155 put. So a little tip here, I by default would do a $10 wide spread on the Russell or SPX for that matter, $10 wide on the index. If I do them on the ETFs, I'm usually doing $5 wide. Okay, that's the spread width or the distance between the strikes, as we say. Well, if I did that when the stock was at 200 and the stock went up, I'm good. Puts will expire worthless. Keep the credit you got paid up front. If the market goes sideways, I'm good. Puts expire worthless. If the market goes down, I'm actually okay if it gets to 190, 180, 170. I just don't want it to go below 160. If it does, I'll lose. Okay, easy enough. What would the bear call look like? $200 stock. I'm going to sell the 224 call up here. And I'd probably buy the 229 call because that would make it a $5 spread. So I sell this guy, I buy this guy. So listen, we can go up 205, 210, 215, 220, we're fine. Just don't go above 224. Sideways, I'm A-okay. Down, I'm obviously A-okay. So if I just did the bear side, that would be what I'd be hoping for. But again, I'm doing both. Bull put plus bear call. So I'm sorry, I don't even know what I'm trying to say here. I'm going on both sides. There's a word I was looking for. I don't know where it went. I am putting on both sides here, both verticals. I want it to stay in the range. So one way you could articulate this is you could say stay below 224 and above 160. Do anything else you want, Mr. Russell. Just do not go above 224 and do not go below 160. Right? So if you go up too far, no good. If you go sideways, hey, let's, good job. Attaboy. Down too far, no go. That's the Condor. That's the Condor. That's what we're hoping for. Okay. All right. That's it. That's the idea. All righty. So what is an Iron Condor? Well, we should know that. Check. How do you enter, manage, and exit the trade? Let's move on to that. How do you enter, manage, and profit on the trade? Well, listen, the entry guidelines, right? What did we say? We said use maybe the RUT or IWM. Okay, we're going to build. Actually, we're going to use maybe around 60 days to expiration. Okay, we're going to sell a delta less than 10. So I'm going to go pretty far out of the money. I'm going to do a $10 wide spread on the RUT or a $5 wide spread on IWM. Okay, so let's build one. Okay, I'm going to start with the Russell 2000. I only use monthly options. No weeklies. I want to stick with the most liquid options available, and those are the monthlies. So we have 52 days to May expiration or 80 days to June. 80 days, forget it. 80 days, forget it. Too far away. 52 days, sure. Okay. We would have done these 8 days ago if I was being very consistent to that 60 days to expiration guideline. Okay. So May, let's open those up. 52 days, close enough. Okay, close enough. I think this will suffice. You have to have a column heading that shows the delta, because that'll kind of tell you where to start. So as I survey here, I see some deltas around 10, 9, 8. And then as I look over here to the left, I see that the strikes, which were $5 increments, then go to $15, then $50 wide increments. Do you see that? And as a result, the deltas start to jump more. This has been a recurring problem for the last couple of months in the Russell 2000 index. Okay. We know, those of us that are on the cash flow Condors premium system, we meet every month to try to build something on the Russell. And we've had this issue where there aren't always strikes available. So listen, if I'm going to do a $10 wide spread, the furthest I can go is 1775, 1765. Okay. Could that work? Well, it's still below a 10 delta. So there's different ways of building the order in Thinkorswim. The way that I like to do it is I click on the bid price. So there's a bid price and an ask price. If you want to sell, you click on the bid. If you want to buy, you click on the ask. So I want to sell the 1775 put, and then I hold my control key on my keyboard, hold it down, click on the ask of the one you want to buy. Boom. It puts them together, builds a vertical spread. This is what the order looks like for a bull put. And we're getting about 70 sets. Now, I didn't tell you this yet, but I'll give it to you as another guideline. If you're getting a delta around 10 or less, I would like to get at least, I want around 60 cents per $10 wide spread in rut. Okay, so that translates into, that gets me about $1.20 for the entire Condor. That's what I'm shooting for. 70 cents is really more than I need. But like I said, beggars can't be choosers here. If we're going to do it on the rut, that's about as far away as I could go. Normally, I'd say, oh, you'll give me 70 cents. Can I go a little further out of the money? 1760, 1750 maybe? 1755, 1745. If those strikes were available, I would do a little bit of guess and check here, build a couple different ones, and see if I can get a little further away. Okay, but as of right now, I'm at 1775. So if I draw a picture on the chart here, not a picture, a line 1775. Okay, well, let's zoom out to a 5-year chart. Let's extend this to the left. What do you think? Do you think that's far enough out of the money? Does that give you a wide enough range? Are you comfortable betting the Russell's going to stay above 1775? Percentage-wise, we're at 2078. You're at 1775. You're 300 points away. Divide that by 2078. You're about 15% out of the money. You're about 15% out of the money. So let's say you're comfortable with that, okay? Let's pretend you're comfortable with that. If you weren't and you wanted to go further out of the money, you can't on the Russell. You'd have to go to IWM and build it on the ETF instead. But since I'm in the close enough, good enough camp here, I'm going to stick with rut and see if I can get the bear call side. Okay, so we sold a 9 delta, pretty much a 10 delta bull put on rut. Now, let me analyze the bear side. So I go to the call side of the option chain, go find a delta around 10 or less. Now, fortunately, on the call side, you got more strikes. See how they keep going in $5 increments? So I got my pick of the litter on the call side. I can pick any delta I want because there's more liquidity. There's more strikes available. So let me go to maybe an 8 delta. Let's do a pause. In my order down at the bottom, I want to keep that bull put there. So I'm going to change the advanced order to blast all. And I'm going to build the bear call now. So I want to sell the 2290, but not naked. I want to cover it. Hold the control key. Click on the ask of the 2300. Creates a $10 call vertical spread. That right there, vertical call credit, that's a bear call spread. 75 cents credit. That's more than I need. So see, in this case, I might try to go a little further out of the money. Could I do maybe 2300, 2310 for 60 cents? Yeah, that would work. Now, I want to be somewhat balanced, okay? I don't want to sell a bull put for 70 cents and a bear call for 20 cents. It's too lopsided, too unbalanced. I want a similar credit on each side. This will be good enough, 2300. 2310. Okay, let's draw a line at 2300 here. There's 2300. Okay, how do you feel about the range? We just need Russell to stay between the two red lines. 2300 minus 2078. It's about 11% higher. So I've got about 15% to the downside, about 11% to the upside. That's the profit range. And if you sell both, you're getting about $1.30 credit. Okay, we're getting about $1.30 credit. So let's build this example here. So I got RUT at 2078. The bull put was 1775, 1765 for 70-cent credit. And the short delta was basically 10. And then on the bear call, it was 2300, 2310 for 60 cents credit. The short delta there, I believe, was 8. Okay. So the net credit, add them together, $1.30. Okay. So we are shooting for, like I said right here, about $1.20 for the whole Condor. And this is kind of mimicking the cash flow Condor rules for an index. You could massage these, but just the starting point checks the box. Now, the probability of profit, you take 1 minus the short call delta, which was 8, minus the short put delta, which was 10, you're basically 0.82 or 82%. Okay. When we're selling 8 deltas, 7 deltas, we're around an 85% probability of profit. Okay. So baseline odds suggest we should win about 8 out of 10 on average. Now, what is my risk? Well, if I'm getting $1.30, this is what we call a $10 spread. The maximum risk is $10. That's the spread width minus the net credit. Right, so $8.70. $8.70. That's the max loss. Okay, so max reward or net credit, $1.30, max risk, $8.70. Okay, so what you discover, this is a high probability trade, but it carries kind of, lopsided risk reward, right? So it feels like I'm risking a lot to make a little, right? I'm risking a lot to make a little. How do I get comfortable with that? How do I get comfortable with that? Well, I'm going to talk about that here in just a second, but let me mention one other thing on this order entry. Now that I've got both sides of these built, I don't want to put them in as 2 separate orders. I want to get them all in or none of them, all or nothing. Fill the whole Condor or don't fill it at all. So I got to redo the order and go back to single order. So I'm just placing one at a time. So it took off the bear call. Still have the bull put. I need to rebuild the bear call spread, holding control the whole time. And then it will add the bear call to the bull put. So hold control. I sold the 23. I bought the 23.10. Click on the bid of the 23, the ask of the 23.10. Boom. Adds the bear call to the bull put, even changes the order type and calls it an Iron Condor. There's my $1.30 net credit. Bada bing, bada boom. One thing I'll kind of best practice here, it's defaulting to the middle of the bid and the ask. Again, this is a basic concept that if you've never traded options before might be new. There's a bid-ask spread that's fairly wide on these options. And there's no guarantee you can get filled right in the middle. So especially when you're building a Condor with 4 options, you're splitting 4 bid-ask spreads. It's a wide bid-ask for the whole spread. That is the whole strategy here. So that midpoint's a moving target. And what I discover is often you got to massage the order once or twice before you get filled. So if you just put in $1.30 and hit, all right, fill me or not, probably won't fill you. I often have to drop the price to $1.25 or $1.20 and maybe move it 5 cents. In this case, you're going to be lowering it 5 cents, maybe once or twice to get filled. That's a pretty common occurrence for me. Okay. Well, let's right click and analyze the trade. This takes us over to the Analyze tab. And if it doesn't pop it up automatically, you'll click on the risk profile here. And then make sure that you only have the one trade that you built selected, and you'll see the risk graph. You'll see the risk graph for the trade. Now, notice the left-hand side. That left-hand side looks like a bull put. The right-hand side looks like a bear call. And we've married them together and created an Iron Condor graph. So here's where we're at right now. We're just kind of in the middle. We don't want the stock to go up too much. We don't want the stock to go down too much. We just want time to pass and the options to decay, and we'll collect the premium. So this is not what we call a directional trade, a delta trade. It's a theta trade. In fact, if you look, my delta is basically zero. This is a delta neutral trade. It's theta. Time decay that's really driving the bus here. So as time passes, as we get to April 4th, April 10th, April 11th, look what's happening to my graph. The purple line is going up into the profit zone. Time passing helps the trade. It's kind of a race. We want to get to expiration faster than the price moves out of the range. As long as the stock stays in the range, by expiration, we're good to go. So what's the management here? We need a profit target and we need a stop loss. So the profit target 1, you could ride to expiration and let the spread expire worthless. Right now, there's about 52 days to expiration. If you wanted to, you could hang out, twiddle your thumbs, and if at expiration we're below 2,300 and above 1775, the calls and puts will be worth zero. They'll go away, and you'll get to keep that $1.30 credit you got up front. So if you want all the gain, fine. You gotta ride to expiration. Okay, that's a legitimate technique. Some people will get out early. So profit target 2, you're going to close the bull put or bear call. You can call them, close them separately. Once you can buy them back for maybe around 10 cents a piece. So the way it works is if the stock goes up, you're going to hit your target on the bull put first. Those puts are going to decay in value quicker than the calls because they're moving further out of the money. So if the bull put drops to 10 cents and the bear call still has $1 of value, close the bull put side. There's not much added value or additional profit in store if you stay in. So peel it off. And then, hopefully the stock maybe goes down and then allows you to peel the bear call side off at 10 cents. And then collectively, you would have paid 20 cents in total to get out. So if you got in at $1.30, you got out at 20 cents, you would have made $1.10 net. Some people will do that. They'll exit early. And I think 10 cents is a good number. It's hard to wait till you get 5 cents because they make you ride like really close to expiration. So if you're going to exit early, I feel like 10 cents is about as good as you're going to get. Okay. I've done both. Sometimes I'll ride to expiration. Other times I will close early. Now, probably the most important piece is what do you do when you're wrong? The reason this is so important, especially for this type of trade, is your potential loss is so much larger than your potential gain. You just can't afford to eat the max loss. This should be intuitive. If I can make $130 when I'm right, but I lose 870 when I'm wrong, how many winners is that? 870 divided by 130, it's almost 7 winners. Anybody here want to give up 7 winners when they're wrong? I mean, that sounds terrible. Like you go 8 months with this trade, you win 7 months in a row, and the 8th month you lose, and you give back all previous 7 months worth of gains? Gross. You don't want to do that. You can't afford to do that. So let me start by stating the obvious. You have to do something if you're wrong. You can't just ride this into the ground. Occasionally, the market will move up too much or down too much. For instance, how about after the vaccine came out, the Pfizer vaccine in November of 2020? Do you remember when the stock market skyrocketed? Do you think that put some pressure on neutral trades? I assure you it did. If you didn't do anything and the Russell just ran up too much and ran through your bear call and you lost 7 winners, you probably didn't make money with this system. So you got to do something when you're wrong. Okay, so if Mr. Russell pops to 2,300, drops to 1,775, at some point you got to get out. And there's lots of different techniques. The one that I'm going to teach tonight is simply to exit the losing side if you hit your short strike price. Okay. Per the risk graph, the typical loss is $3 to $4. So in this case, what I'm saying is, and let's take this back to today, if we go down to 1775, get out. Risk graph says you'd lose about $300. Better than 870. You're giving back 2, 3 winners instead of 7. I can live with that. What if the Russell goes up too much, gets up to 2,300? You're down about $340, $350. 2, 3 winners, better than 7. Better than 7. Okay. So get out if it moves too far and hit your strike. And you lose, like I said, 3 to 4. Now, could it gap and you lose more? Yeah, it could. Yeah, so just like any regular trade, if the market jumps past where you plan on getting out, there is a chance you could lose more, right? There is a chance you could lose more. I would say that the biggest mistake people make with this is they get complacent during a winning streak, and they don't and usually they add size and do too many contracts, right? Then they hit a losing month and give back way too much. Okay. Another mistake is you can't quit after a losing streak or in the midst of a losing streak. You have to keep going. Okay. Case in point, if you go look at what happened post-pandemic, the Russell ran up a bunch and you probably lost on a couple of different months on the bear call side. And probably somewhere around Jan, Fed, you're like, I'm sick of it, Mr. Russell. You're too bullish. I'm done with Condors. And then what did it do? It went sideways for the next 15 months. Yes, indeedy, you quit right before a 15-month win streak. Well done. That's the risk you run when you are unsystematic and kind of allow randomness to mess with you. So I like a small size. Don't over leverage. Small size, but do it consistently, and usually it works well in the long run. Okay, that's how you enter. Those are ideas for management and when to exit if you're right or wrong. Now, let me end with why does it make money? And I'll take, if I can, maybe a few questions. So why, you have to have confidence. Whatever system you're doing, you have to have confidence that it's going to make money, not every time, but over time. Okay. Why? Why would it do that in this case? Like, so what is the edge of the Iron Condor? Why should I expect this to do well over time? A couple of the kind of assumptions that you have to buy into to expect to make money with this over time, or maybe these are the reasons why to do it, right? So number one, you don't want to predict direction every month, or at least you don't want to rely on guessing if the stock's going to go up or down to make money. You'd rather rely on something more predictable. Okay, well, that's a sign that you might like this type of strategy. Okay. Two, you believe indexes are, range bound more often than not. And that really means that you buy into the fact that prices exhibit mean reversion, or that they tend to mean revert. A good example of that actually would be what the Russell has done over the last 15 months. It's had periods of strength and weakness, but all in all, it hasn't really gone bonkers. Now, it has its moments, post-pandemic, that was not a good time for Condors. So it goes in and out of favor, but in general, if you think that most months the market doesn't drop 15% or go up 10%, something like this type of Condor should do okay. And the third one, which is really a biggie that we talk about in cash flow Condors, is that you believe options are overpriced, that basically the market moves less than expected. Okay. Traders are willing to overpay for insurance. In a lot of ways, you're selling insurance when you sell a Condor. You're the insurance company betting against disaster, betting against something amazing on the upside, for instance, and just betting on traders' willingness to pay a little too much for options. They're just a little fat. And you're capitalizing on that by systematically selling options. If you don't buy into that, if you think that options are consistently underpriced, then I would never do Condors. Now, you're delusional. They are not underpriced. They tend to be overpriced. But you got to buy into this idea, right? You got to buy into this idea. Okay. That's the presentation, ladies and gentlemen. That is Iron Condors for beginners. My hope, we've been over about an hour. I feel like we've done as good a job as you could do in an hour to bring somebody up to speed on what the heck the Condor is all about. What are some baseline rules and guidelines for getting started, entering, managing, exiting the trade, and understanding really why something like this should work over time if you stick with it. Now, there are a lot of different ways of mapping out the trade from an orders perspective. Okay, I could spend an hour going through the 10 different ways you can build the order in Thinkorswim and such. So it's going to take a little bit of getting used to in terms of mapping things out. Some people like to preset the entries and exits. Others like to do it manually. There's all sorts of different ways that you can build those orders. This is something we spend a lot of time doing over at tackletrading.com is helping people know how to apply the theory, how to execute the strategies. We have an entire course on Condors. If you go to tackletrading.com, you go to the store tab, you will see that there is a premium system called Cash Flow Condors, which goes step by step through this Condor system. So if you click on the Learn More section of that, you will basically see the pitch for what is in the Cash Flow Condors system. Okay. We meet every month. When you get the system, you get a mastermind with it. And in fact, all pro members, now that I think of it, of Tackle have access to the Condors Mastermind group. So we're meeting every month together, talking through the system. showing examples of how it's working or how you would build it in the current market condition. And so you've got that to look forward to if you want to learn more about it. But let me just look at the chat window here before I bounce and see if there's any questions that I can tackle before I bounce. Yeah, do you ever leg into the Iron Condor? I personally don't. It's a legitimate technique. The concept, just to bring everybody up to speed, is, well, what if I'm a little bit bullish? Why not do the bull put first? And then after we go up, then do the bear call. Maybe I can get a little further out of the money, or maybe get paid a little bit more. So can I strategically time when I do the bear side versus the bull side? Listen, if you are right every time, you definitely should leg in. Okay. What I find difficult is I'll think that the market's bullish. I'll do the bull put spread first, and then the market will drop. And then I got to scramble to sell the bear side and complete the Condor. But since my timing was off, now I get a worse price. And it's kind of like, hey, part of the reason I liked the Condor was that I didn't have to guess direction. And yet now, because I'm legging in, I'm forcing myself to pick a side every month. Well, do you think it's going to go up over the next week or down? It's like, I thought the whole objective was to sidestep the whole directional guessing. So I try to keep this kind of by the book. And if I have a strong directional opinion, I don't necessarily let it influence my cash flow Condor system. I let it influence my other trades. So I kind of treat this as a standalone. And then if the market really is all that bullish, I'll just express my opinion, let that bullish bias influence me, not by tweaking the Condor every month, rather by placing more directional plays. Okay. So I kind of look at it like this 2,300, right? If I sold the bear call up at 2,300 for the Russell, we may get to 2,300. In fact, I hope we do. I hope we get to 2,300 by May, not because it'll help me on the Condor. It won't. It'll hurt me on the Condor, but because that will be the stock market going up 10% over the next 2 months. I would hope that I can make enough money on other trades to offset what I lose on the Condor. So I kind of, allow my directional bias to influence what I do elsewhere versus trying to over optimize or over tweak this on a monthly basis. Okay. In terms of sizing rules, I mean, the default answer for size is you do one for every $300 to $400 you're willing to risk in this system per month, essentially. So if I have a $50,000 portfolio, then I say, well, how much money am I willing to lose if I'm wrong on the Condor? If the answer is $1,000, take $1,000 divided by 300 to 400. Basically, you're doing 3 contracts. Okay, if it's risking around 350, I guess. So if you're willing to risk $2,000 a month, you're doing 6 Condors, right? So there's not a right answer, Gino, but that's the logic I would use. One of the guidelines I've given before is I like kind of the idea of 1 per $10,000 in the account being the max. That would mean you're risking 3 to 4% a month in this particular system. I would be uncomfortable doing more than that. I tend to do less, in fact. But it's always easier to scale up than scale down. Meaning it's always easier if you maybe start with 1 contract a month and then do 2 contracts a month and then 3 contracts a month and then 4 contracts a month and kind of scale up to what you're comfortable with, than to start out doing 20 contracts a month, have 2 losing trades in a row and quit. It's like, well, you got to be able to survive losing streaks. And occasionally you'll lose 2 months in a row with this. Occasionally you might even lose 3 months in a row. So if you want to be successful using a system for forever, you got to survive those losing streaks, and you got to go through the math of, hey, if I did on a $50,000 account, if I did 20 contracts every month, you know, I'm down six to $8,000 on a losing month. 3 losing months in a row, I just lost half my account. I can't do 20 contracts a month. I'm going to blow up my account. Okay, well, what can you do? Walk it back. Can you do 2? Can you do 3? I think if you just do the math yourself, you'll get more intimately familiar with, okay, what would a winning month look like? Now, what would a losing month look like? What would 2 losing months in a row look like? What would 3? Whatever answer you come up with, whatever size you ultimately settle on, you just have to make sure you can handle the losing streaks. And I, again, will always go back to the November 2020, when this thing gave you a couple of losers in a row, and then it gave you like 13, 14, 15 winners in a row. And you didn't get the big winning streak unless you're willing to live through the losing streak and stick with it. Okay? Because inevitably, I'll teach some people where their first 2 trades are losers. I'll teach others where the first 10 trades are winners. I don't know. It's random as to when you start. So I just know in the long run, if it's a good system, it should add to your bottom line. But you got to be able to stick with it. Okay. On that note, I'm going to let you guys go. Really appreciate you taking the time out of your night to be here. If you're watching this on recording, thanks for hanging out whenever you watched this. But we're happy to help. Come join us, tackletrading.com. And I'll see you guys on the inside if you want to come check it out. We always give free trials, and Condors is a recurring theme on our various webinars and everything. So thanks again for your time, guys. Best of luck, and we'll see you next time.